The set is officially staged for Ripple and XRP dominance in 2026, and if you are paying attention to what is happening right now, you can feel that something big is changing in the crypto world. This is not hype, this is not retail noise, this is structure, regulation, and institutions quietly moving into position. Today's video is important because what we are about to talk about explains why 2026 could be the year where crypto finally steps out of chaos and into clarity, and why XRP is sitting right at the center of that shift. Welcome back to We Are Cosmic. If you are new here, this channel is about understanding crypto from an expert finance perspective, not chasing pumps, not emotional trading, but breaking down what is really happening behind the scenes. We talk about regulation, institutions, infrastructure, and long-term positioning, the things that actually move markets over time. And if you have been with us for a while, then you already know. We don't just react to headlines, we connect the dots. We are entering the first real week of 2026, and honestly, take a moment to feel that. We made it through another year together, a year full of noise, delays, frustration, and uncertainty, but also a year that quietly laid the foundation for what comes next. A lot of people are still focused on price alone, but smart money is watching policy, regulation, and rails. And that is exactly where today's conversation begins. Recently, we heard from David Sachs, one of the most important voices connected to crypto policy and regulation in the United States. And what he said matters more than most people realize. For years, the biggest problem holding crypto back was not technology, not speed, not adoption. It was regulatory uncertainty. Builders were not afraid of rules. They were afraid of not knowing the rules. Imagine trying to build a business where you only discover the law when you are punished for breaking it. That was crypto under the previous regulatory approach. For nearly 4 years, crypto companies lived under what can only be described as regulation by enforcement. No clear guidelines, no clear definitions, just lawsuits and fear. Entrepreneurs were forced offshore, innovation slowed down, and the United States risked losing its position in the future of finance. Many people believed that once someone who understood blockchain entered the regulatory space, things would improve. Instead, the opposite happened. Now something has changed, and this is where 2026 becomes critical. There has been a full regime shift in how crypto is viewed at the highest levels of government. Regulatory bodies are no longer working against each other. The SEC, CFTC, Treasury, Federal Reserve, and even state-level regulators are moving toward clear, unified frameworks. This is not speculation. This is policy in motion. The Genius Act has already been signed into law, creating an official framework for stablecoins. The Clarity Act is moving through Congress and is expected to define how crypto assets outside of stablecoins are classified and regulated. For the first time, banks, asset managers, corporations, and institutions can see a roadmap. And when institutions see clarity, they move fast. This is why we are now seeing stock market tokenization, DTCC involvement, and major financial infrastructure preparing to move on-chain. Not someday, not in theory, but starting now in 2026. And when you understand this backdrop, XRP's positioning starts to make a lot more sense. Because this next phase of crypto is not about memes. It's not about hype cycles. It's about compliance, privacy, settlement, and trust at scale. And that is exactly where XRP and the XRP ledger enter the conversation. Now let's go deeper, because this is where most people completely misunderstand what institutions actually need from blockchain technology. Retail investors often think speed and low fees are the biggest selling points. Yes, those matter. But for banks, asset managers, and large financial institutions, privacy is the real battlefield. And until privacy is solved properly, mass institutional adoption cannot fully happen. When you listen to executives from major banks like JP Morgan, the message is very clear. They are not afraid of blockchain. They are not afraid of tokenization. In fact, they are already using it, but they are doing it on private chains, not public ones. Why? Because public blockchains expose too much information. Transaction amounts, positions, strategies, and balances are visible to everyone. That might be fine for retail users, but for institutions, that is unacceptable. Think about it from a bank's perspective. Would a bank ever want its competitors to see its liquidity positions in real time? Would an asset manager want the world to know exactly how they are allocating capital when they are entering or exiting positions, or how much exposure they have? Of course not. That kind of transparency would be a strategic disaster. This is why many institutions built private blockchains and kept everything in closed environments. For a long time, people thought settlement speed or throughput was the blocker, but those problems are mostly solved now. The real issue holding institutions back from public blockchains is selective disclosure, the ability to prove compliance without revealing sensitive data. And this is where the XRP ledger starts to stand out in a very serious way. The XRP ledger is emerging as what you could call a privacy-first public ledger for institutions. And this is important, not privacy in the sense of hiding everything, but privacy in a regulated, programmable, and auditable way. Instead of hiding activity on layer 2s or using complex off-chain solutions, XRP Ledger is building privacy directly into the core infrastructure. One of the most powerful developments here is the integration of zero-knowledge proofs. In simple terms, zero-knowledge proofs allow an institution to prove that a transaction or position is valid without revealing the underlying data. That means a bank can prove it meets regulatory requirements like solvency, capital limits, or exposure rules without showing the actual numbers to the public. This creates something extremely important: privacy-preserving compliance on a public ledger. Institutions no longer have to choose between transparency and confidentiality. They can have both. Regulators can verify compliance. Counterparties can verify limits. And the public network remains secure, all without exposing sensitive financial data. This design is not accidental. XRP Ledger is clearly targeting high-value institutional use cases like real-world asset tokenization, collateral management, and institutional DeFi. These are areas where confidentiality and auditability both matter, and very few blockchains are designed to handle both at the base layer. Another key development is the introduction of confidential multi-purpose tokens, often referred to through the MPT standard. These tokens allow balances and transfers to be encrypted while still keeping supply rules and issuance limits publicly verifiable. In simple terms, the system knows the rules are being followed even if the exact amounts remain hidden. What makes this even more powerful is selective disclosure. Institutions can grant viewing or audit rights to regulators or auditors without making that data public to the entire network. This is exactly how traditional finance works today, just upgraded for a blockchain environment. Ripple understands this because it has been working directly with financial institutions for years. This is not something many influencers talk about because it is not flashy, but this is how real adoption happens, quietly, structurally, with infrastructure that fits how institutions actually operate. And here is the key point. Once privacy is solved at the base layer, institutions no longer need to rely on private chains. They can move to a public ledger without sacrificing control, confidentiality, or compliance. That is a massive shift. Now that we've established why privacy is the real blocker for institutional adoption, let's talk about why XRP Ledger is uniquely positioned to solve it compared to other blockchains, like Ethereum, which rely heavily on Layer 2 or Layer 3 solutions. This is where the difference between hype and real infrastructure becomes crystal clear. Ethereum and other Layer 1 blockchains often need multiple Layer 2s to scale. These L2 solutions aim to increase transaction speed, reduce costs, and provide some privacy. But here's the problem: fragmentation. When liquidity is split across multiple layers, it becomes harder for institutions to manage large flows efficiently. Cross-chain settlements are slower, complex, and sometimes risky. In contrast, the XRP Ledger builds privacy, compliance, and high-speed settlement directly into the main ledger, which means institutions don't need multiple layers to achieve their goals. Imagine a bank wanting to settle millions of dollars worth of assets in real time. On a fragmented network, part of the liquidity might be on Layer 2, part on Layer 3, and part on the main chain. This makes risk management and auditing extremely complex. On XRP Ledger, all of this can happen on a single unified chain with final settlement in 3 to 5 seconds. No fragmentation, no multiple bridges. This is why institutions are already evaluating the XRP Ledger as a base for real-world, high-value financial operations. Another key aspect is programmable privacy and computation. XRP Ledger is integrating zero-knowledge proofs into smart contract environments. What does this mean in practice? Institutions can now perform complex checks like capital ratios, credit limits, and liquidity constraints directly on-chain without revealing sensitive portfolio data. You don't have to trust a third-party system. You don't have to leak strategic information. Compliance is verifiable, private, and programmable. XRP Ledger also allows for hybrid circulation. This means the same token can exist in both public and confidential forms, and institutions can convert between the two seamlessly. For example, a bank could use a token publicly for liquidity purposes while keeping its treasury or OTC positions private. This dual model is essential for high-value financial players who need flexibility and confidentiality simultaneously. We also see built-in compliance controls baked into XRP Ledger: transferability rules, freeze functions, multi-signature authentication, and optional clawback on confidential balances allow banks and asset managers to operate in a way that meets regulatory requirements. Essentially, the ledger is already designed with the needs of regulated institutions in mind, not just retail users. Contrast this with other ecosystems. Ethereum-based Layer 2 solutions might offer privacy features, but they still require bridging assets and managing complex protocols. Liquidity is fragmented, and final settlement can take longer. For institutions moving billions in digital assets, every second and every point of friction matters. XRP Ledger reduces that friction by design. Finally, let's remember what this means for adoption. Institutional players are not experimenting with toys. They are looking for systems that are efficient, auditable, secure, and compliant. XRP Ledger ticks all these boxes. That's why we are seeing early signs of serious momentum, massive purchases in South Korea, high-value transactions quietly happening off the public radar, and major Wall Street firms like Vanguard starting to offer access to Ripple-related products. This is no longer retail speculation. It's the beginning of institutional adoption at scale. Now that we understand why XRP Ledger's design is perfect for institutions, let's connect it to the regulatory landscape, because this is what will truly determine adoption at scale. Infrastructure and technology matter, but without clear rules, even the best blockchain sits idle. That is exactly what the crypto industry experienced for years. Uncertainty held everything back. For nearly a decade, crypto innovators in the U.S. were navigating a regulatory minefield. Under previous administrations, enforcement often came before rules were clearly defined. Companies didn't know if their tokens were securities, whether stablecoins were compliant, or how DeFi projects fit into existing laws. This created fear, slowed innovation, and pushed talent offshore. A lot of smart developers and financial engineers left the U.S. simply because they didn't feel safe building here. Fast forward to 2026. The landscape has shifted dramatically. Legislative and executive actions are giving the market clear guidance for the first time in years. The Genius Act, signed into law, officially defines the framework for stablecoins. Soon after, the Clarity Act is expected to pass, providing guidance for all other crypto tokens. Once it's enacted, banks, asset managers, and corporations will finally have certainty on what qualifies as a security, what rules they need to follow, and how to integrate crypto into their existing systems. Why does this matter for XRP? Because XRP is uniquely positioned to ride this wave of regulatory clarity. Unlike many other blockchains, XRP was built with compliance and institutional needs in mind from the start. Its token and ledger structure already support issuer-level tools such as transferability rules, multi-signature authentication, and KYC AML compliance. When the law clarifies exactly how crypto assets must operate, XRP is ready to comply without major adjustments, giving banks and other institutions confidence to adopt it quickly. This clarity is a green light for mass adoption. Think of it like traffic signals for crypto infrastructure. Before, the lights were all broken. You didn't know if it was safe to go. Now the lights are fixed, institutions can move forward, and XRP Ledger is already at the intersection, ready to handle high-value transactions with speed, privacy, and compliance. The regulatory progress is not just US-centric. Globally, central banks and financial institutions are observing these frameworks closely. They see that the US is trying to become the crypto capital of the world, and Ripple's partnerships position XRP as the default choice for compliant cross-border transactions. In other words, it's not just about technology, it's about being in the right place when global standards are defined, and XRP is there. The effect is already visible in market behavior. Large-scale purchases like the 4.8 million XRP buy in South Korea are signaling that professional investors are starting to view XRP as Wall Street ready, not just a retail token. Firms like Vanguard are including XRP alongside Bitcoin and Ethereum in structured offerings. These are not casual endorsements. They reflect confidence in XRP's ability to operate within a regulated, secure, and high-performance environment. This also ties into the broader financial ecosystem. Treasury departments, central banks, and institutional players are now incentivized to move onto blockchain rails because it reduces friction, accelerates settlements, and lowers operational costs. Once the Clarity Act and related policies are finalized, banks will begin integrating XRP Ledger into stablecoin infrastructure, treasury operations, and real-world asset tokenization. This creates a roadmap for XRP adoption that is predictable, measurable, and scalable, unlike the chaotic cycles we've seen in retail markets. Now that we've established regulatory clarity and the XRP Ledger's technical advantages, let's talk about real institutional momentum. This is where theory meets action and why XRP is no longer just a retail story. In 2026, XRP is moving from the background into the center of Wall Street and global finance. First, consider the size of recent transactions. South Korea alone saw a 4.8 million XRP purchase in a single day. To put that in perspective, that's almost a quarter of the daily volume of a typical ETF launch. These are high-value strategic purchases, not casual retail trades. They signal that professional investors are quietly accumulating XRP in preparation for large-scale adoption. Retail noise often dominates headlines, but institutional moves like this are the true market indicators. Another key trend is the shift in Wall Street's attitude. Historically, firms like Vanguard, BlackRock, and other asset managers avoided crypto. They considered it too volatile, too uncertain, or too unregulated. But now, with regulatory clarity and infrastructure like XRP Ledger capable of handling confidential, compliant transactions, these institutions are changing course. Vanguard, for example, has publicly acknowledged offering exposure to crypto ETFs, including Bitcoin, Ethereum, and Ripple-related products. This signals a massive shift from skepticism to adoption, which will have a ripple effect across the financial industry. Let's talk about the mechanics of adoption. XRP Ledger's confidential multipurpose tokens, MPTs, allow institutions to manage both public liquidity and private treasury positions simultaneously. A bank can operate in the public market while keeping sensitive positions private, all verified by zero-knowledge proofs. This design removes the last real barrier for institutional adoption, balancing transparency for regulators with strategic confidentiality for institutions. Once banks see they can have both, there's little reason not to move billions of dollars onto XRP Ledger. Multi-purpose tokens also enable real-world asset tokenization. Collateral management, corporate treasury operations, and cross-border settlements all benefit from confidential tokenized structures. Instead of fragmented liquidity across multiple layers, XRP Ledger consolidates these operations on a single chain, allowing for faster settlements, lower fees, and higher security. For institutions, efficiency translates into cost savings and operational control. And that's why XRP is being prioritized over other chains that require complex Layer 2 networks. Beyond technology, adoption is also fueled by strategic partnerships. Ripple has been collaborating with global banks, regulators, and sovereign wealth funds to ensure XRP fits within the real-world financial system. These partnerships are not speculative, they are operational. Banks are already testing XRP rails for treasury and cross-border payments. Sovereign wealth funds are including crypto allocations in their portfolios, and XRP is positioned as the most compliant, privacy-aware, and scalable choice. Here's the takeaway. XRP's current market activity is not about hype cycles or retail FOMO. It's about structural adoption. The moves we are seeing now, large institutional purchases, regulatory frameworks falling into place, technical advantages baked into the ledger, are all the signs of sustainable long-term growth. 2026 is shaping up to be the year where XRP transitions from a speculative asset to a core financial infrastructure token. We've come a long way in understanding XRP's unique position in 2026. From regulatory clarity to privacy-first infrastructure and institutional adoption, everything points to a critical shift in the crypto landscape. In this final part, we connect the dots and see what it means for XRP, other altcoins, and the broader financial system. First, let's address the broader market. While XRP is leading in institutional adoption, it doesn't exist in isolation. Other networks like Solana are also gaining traction for speed, low fees, and developer-friendly ecosystems. Solana's rise is important because it shows that the crypto world is becoming multi-chain and multi-purpose. Investors are no longer putting all their eggs in one basket. The narrative is shifting from single-coin hype to diversified infrastructure strategies. But here's where XRP stands out. Unlike most altcoins, XRP is designed for compliance and large-scale financial operations, not just speculative trading. While Solana and Ethereum compete on smart contract flexibility, XRP is tackling real-world banking needs, privacy-preserving transactions, multi-purpose tokens, and rapid settlements. When global banks, asset managers, and regulatory bodies evaluate blockchain solutions, XRP meets all three critical criteria: speed, privacy, and compliance. The institutional momentum we discussed in Part 5 is only going to accelerate. Once acts like the Clarity Act are fully implemented, XRP will become the default choice for banks looking to integrate digital assets into treasury operations, cross-border payments, and real-world asset tokenization. Every day of regulatory uncertainty removed is a day where large institutions feel safe to deploy billions of dollars in XRP, quietly, efficiently, and compliantly. We are also seeing a cultural shift in finance. Wall Street is no longer treating crypto as a fringe asset. Sovereign wealth funds, hedge funds, and top-tier asset managers are now openly talking about allocations in crypto. Treasury departments and major banks are designing rails and stablecoin integrations, and XRP is already compatible with these rails, giving it a first-mover advantage. In 2026, adoption is not a question of if, but when, and the signs point to rapid scaling. Another crucial factor is public perception versus institutional action. Retail investors often get caught up in price predictions, hype cycles, and social media sentiment. But the reality is that institutional adoption drives sustainable growth, not viral trends. XRP's focus on privacy, compliance, and real-world financial use cases makes it a structural winner. Retail hype may come and go, but when banks, asset managers, and regulators align with a ledger, that creates long-term demand and market stability. Finally, what does this mean for you as a viewer and investor? If you are paying attention, 2026 represents a once-in-a-cycle opportunity. Understanding the regulatory landscape, institutional incentives, and technical design of XRP can help you see the difference between short-term speculation and long-term positioning. XRP is no longer just another crypto token, it's an infrastructure asset built for the financial system of the digital age. In conclusion, Ripple and XRP are entering a phase of strategic dominance. Regulatory clarity, built-in privacy, high-speed settlement, and real-world institutional partnerships converge to create a market environment unlike any before. XRP's momentum is structural, supported by policy, technology, and global financial strategy. If 2026 plays out as the foundations suggest, XRP is not just part of the crypto conversation. It's shaping the future of finance itself. And that is why staying informed, analyzing trends with a critical eye, and understanding the infrastructure behind the hype is crucial.